RBL Bank on Saturday reported an over six-fold rise in net profit for the second quarter of the current year at rupees 201.55 crore, as provisions came down sharply and the net interest income showed firm growth. We have the bank's MD CEO, Mr. R. Subramaniakumar, to discuss the latest results and the way forward. Welcome to the show, Mr. Subramaniakumar.
Thank you. Thank you very much, Bhaskar. Thanks a lot.
You have provided a guidance of 15% loan growth in the current year and 20% for the next. Which are the bank's focus areas when it comes to the credit growth?
Fine. See, if you look at that, traditionally the bank has been growing in two niche areas. That's in respect to the credit card and microfinance. The microfinance, the growth has commenced from the late June of this year. And this quarter, we did around 1,800 crores. And we have a potential to grow more than 2,000 crores in that space, which will continue to grow in that space. The second, traditionally, we are the fifth, sixth largest credit card issuer. And as the spend is concerned, again, we are somewhere in fifth and sixth of amongst all the credit card issuers in the country. And we continue to maintain our leadership position in that. And we will continue to grow around 17% there. But if you look at both of them, it doesn't give me an overall book growth of around 15 to 20%. So we need to look at alternatives available to us or alternatives possible by us. Some of the alternatives which we have identified as a bank is that secured retail credit. So we are going to expand our market in respect of the two-wheeler, used car four-wheeler, and the gold loan during this quarter. And during the next quarter, we'll have a secured LAP loan. And we are going to go for the housing loan in a big way, which is already there in our kitty. And we are going to expand our education loan and personal loan. There are some of the other products which we wanted to roll up during the next quarter. Today, if other than the microfinance, I think we have a wholesale book which is also growing, which is at the rate of, if you look at it, last quarter it grew by 22%, and this quarter it grew by 20%, whereas the other retail grew by around 6%. So we are going to moderate there in order to get a better return. So the return yield, if you look at it, traditionally the corporate doesn't give me much of the yield. The yield is averaging somewhere around 7 to 8% in the range. So that is not going to add up to my revenue, and that is not going to add up to my bottom line. So in order to increase it, we are having a shift within the wholesale banking. That is from the traditional wholesale banking where we may not be able to take a greater exposure. We are moving towards the commercial bank, where the commercial bank, what we propose to do is our rate yield is moved to the closer to 10%, 9 to 9.5%, better than the 7.5%. So another thing is the risk diversification is also another thing we are looking at that. There we will be concentrating on the mid segment and medium industries. These things will also trigger and fire our growth in the credit. So this quarter we clocked around 12% YoY growth, and sequentially we grew by around 6%, and we'll continue to maintain that tempo, and we will be reaching the 15% at the exit of this year, maybe plus slightly more. And next year onwards, we will be able to do 20% plus growth.
You mentioned that the bank basically plans to fund the loan growth with a granular growth in deposits.
Correct.
But the deposit growth was at 5% in July, Sep. It was lagging far behind the advances. So what is RBL Bank's strategy to mobilize funds? And because right now it's a highly competitive environment when it comes to mobilizing funds.
Absolutely right. See, if you look at it, I want to divide this part into two. Today, I'm not looking at the growth in the deposit, the overall deposit, as well as the CASA deposit beyond a point with a simple reason. We have a CD ratio of somewhere around 72 to 76% range. The second, if you look at it, our LCR is 156%, and we plan to close our LCR somewhere 120%. So we are left with a surplus liquidity of 6,000 to 7,000 crore, which we are deploying today in our GSEC and things, which are giving me an average return of 2 to 4%. That will be deployed effectively during this year. And when we have an ability to deploy them and earn money out of it, we don't look at that CASA growth immediately. But the strategy which we have already started is that instead of depending on the bulk deposit, which comes from the corporate and it has its own volatility, so we are moving away from the bulk and coming into the granular as a strategy. The granular level, what we mean is that we will be increasing the number of accounts. If you look at the number of accounts which has been done during this quarter is double of what has been done in the corresponding quarter of the last year. So this demonstrates the ability of the bank to increase their baseline number of the branches. And if you look at it, one of the specific product or 2-3 specific products of the bank is a totally relationship based. That's one is Insignia. The second is a signature, and we have Prime and others are there. I'm focusing on these two. These are all personally related to the relationship manager. This bank has achieved its specific position amongst all the peers on two fronts. One, it is giving an adequately a decent return and the differentiated rate of interest is higher than others. That will put us one step ahead of the rest of the competitors. The second is our relationship strength is pretty strong, so that they will be able to leverage. So we are going to position the products which I explained just now, all the retail asset product at the branch, empower the branch manager to handle them. So that will also provide me another avenue for the granular deposit growth. The third is we are sitting on a huge pile of customer data, which we have never leveraged for cross-sells and upsell. For example, we have a 4.6 million customer under credit card. This credit card has never been taken beyond the credit card given only, which we wanted to drive it for the liability product. We have around 2.6 million microfinance where the BCs, 8,000 BCs are on the field. They have never been ripped up for the purpose of getting the liability franchising. So these people will also trigger for getting the liability products, which will increase my granular deposit. The third is that we have a payment, 50 lakhs plus customer are using our payment platform for the purpose of doing any of the platform. We have a strong partnership relationship. So this will enable us to reap that and convert even a minuscule part of it, let us say even 10%, if I'm able to rope in, they will be able to get a substantial customer acquiring strategy. These things will happen. Once they are acquired, the engagement will continue through our relationship manager. We will be able to scale up our deposit average deposit, which is residing in those accounts.
So what is your guidance for net interest margins in the current environment? Because banks are facing a lot of pressure to raise deposit rates, as we said. Would you be able to maintain the 4.55% NIM that you are currently at?
With the new products, which is going to give me a higher yield than the average yield which I'm getting it, I'll be able to maintain is 4.5%. Then whatever that extra leverage which I get in interest income in the form of additional one, maybe marginally it will get impacted with my interest expenses because we are in a position we can't afford to give a rate of interest much lesser than others. So my 5.1% of the cost of funds may slightly move up to 5.3. Maybe in a quarter it may move by 25 bps to 30 bps. So which we will be able to compensate by giving our credit growth. So we will be able to maintain our NIM in the same range with this particular strategy.
You had said that one of the key reasons behind the surge in the net profit in July, September was a sharp decline in provisions. Your gross NPA ratios have definitely improved. But could you provide some clarity on the sequential rise in the net NPA ratio?
Yeah, see, there are two things. One is that the net NPA ratio is my provision coverage is coming down. I have to have a higher slippages. GNPA has come down sequentially for the last 4 quarters, which demonstrates that the fresh account which is slippaging is not one which is demanding my more provisions. Number one. This net NPA has gone up because from a restructured book, we have one big account. Which account is that? It's a corporate account, which was technically NPA. Otherwise, it would have continued as a restructured account. It is being serviced regularly. This big account, which is contributed to this particular swing in our net NPA. But it will get stabilized as we move forward.
That's it from our side. Thank you very much for your time, Mr. Subramaniakumar.
Thank you. Thank you. Thank you, Bhaskar. Thanks a lot. Bye-bye.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.